This episode is brought to you by Koifin. Koifin is one of the fastest growing platforms for financial data and analytics to research stocks and understand market trends. Imagine a Bloomberg Lite with tons of high quality equity and macro data, a powerful graph engine that can show it all clearly, and a user interface that doesn't look like it was built in the 1990s. If you're an individual investor, research analyst, portfolio manager, or financial advisor, do yourself a favor and check them out. You won't regret it. Sign up for free at koifin.com. That's KOYFIN.com.
Hit it. It's Friday, October 1st, 2021, episode 151. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome to the show Darius Dale from 42 Macro. We have a fascinating discussion about the macro landscape and why inflation might be both transitory and secular at the same time. Harris is back for Kuppy's Corner and it's jam-packed full of energy, literally. Then Patrick has upgraded his Crayolas to the big 120 crayon pack, and he is keen to try all sorts of colors in talking charts.
This week in trading history, we go back to 1981, where we saw the peak of treasury yields, and we end with the skin in the game, Kev. So, folks, we stick around. We might drink some beers along the way. We got a great show. Lena, hop on. What beer are we drinking this week?
Okay, wait, I got to interrupt.
I fucked it up there.
No, we're going to keep going here, Patrick, because we're not letting you off the hook. Lena,
Yep.
You and I are on the east coast of Canada. We're on a time zone where it's 5:30. Patrick is what? What time is it
Like
there?
11:30 probably?
It's midnight.
11:30, and he is many, many beers into this.
He is well sloshed.
So, Lena, we got to keep Patrick away from the script, because
Yeah.
did you notice it was a little bit of the morose, like not morose, but slow reading? Patrick?
Time passes much slower when you're drunk.
It's right.
so-
Okay, so Lena, what's Patrick
Thank God
drinking
we got a
today?
script.
So Patrick has decided to make me butcher another language today. So he is drinking, I believe this is pronounced, I got to apologize to our Hungarian friends, but it's Pieci Sur, I think it's called.
There you go.
It's spelled like Pesci Sour. I thought it was like a Joe Pesci beer for a second. But it's supposed to be a Vienna lager.
Okay.
There you go. You know what? A shout out to Christian, who came out to the Huddle piss up from. He made it all the way from Budapest, and he brought us some beers to feature on the Huddle. And so, Kev, when I'm back in Toronto next week, you're going to get a couple of these, and we're going to do some of these Hungarian beers.
That's awesome. That's great. Okay, I'm going to try to spare you talking anymore, and I'm going to consult to the... Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the Munger munchies, the frothy bubble boils, or the macro migraines.
All right, let's get to our interview with Darius.
It's our great pleasure to welcome to the show Darius Dale, founder and CEO of 42 Macro. Darius, thanks for coming today.
Yo. What's up, Kevin? How you doing?
Good, man. This is going to be a lot of fun. First of all, before we start, how 42 Macro, where did the name come from?
Yeah, so 42 is an ode to Jackie Robinson. Obviously broke the color barrier in Major League Baseball and really professional athletics here in reality. So, I wanted to do my part and really add to to the value that a lot of people of color, females, genders, people of that nature are adding to the industry, and create a home for a lot of folks who have a lot of things to say. That's diversity to the mix.
Well, that's terrific. When we were chatting before the recording, you told me that you're from Seattle. I thought I'd take this opportunity to tell my Vancouver joke, and I'm just going to amend it to Seattle and see if you think it's funny. There's a fellow who dies. He dies and he's down and he's in this long line of people, and they're one by one, they're going to visit Satan, and Satan either sends you up to heaven or sends you down to hell. And they're going through them, and you see a person, and Satan takes them, puts them down into hell, or he takes the person and sends them up, and one by one this goes on. And every now and then there's a person that gets tossed off to the side. And this fella is thinking, oh, geez, this is kind of strange. Like, what's with those guys, right? So finally it comes his turn, and he's there, and he's ready to, get his moment of judgment. And he says, oh, Dark Lord, before you, make your judgment, can I ask you a question? And Satan says, sure. And he says, you know, I see the people going to heaven. I see the people going to hell. What are those people off to the side? And he says, those people are from Seattle. They're too wet to burn.
Yeah. Oh, it's mean, man. It's true, though. It's so true.
So you grew up in Seattle. Is it as wet as Vancouver?
I would imagine. I mean, so you know this from living in that region.
Well, no, I'm actually, I grew up in Winnipeg, and it's dry as anything. It's cold, and then
cold as hell.
Yeah. So I actually, I'm not very good with the rain, but I have a lot of buddies from Vancouver, and I always find that that never seems to bother them when it's just kind of drizzling outside, and they love it. They're kind of like Londoners.
Well, it's the funny thing. If you grow up there, you don't realize that it's raining ever, because it's raining like 6 months in a row. It's like kind of drizzling. Like I never owned an umbrella growing up until I moved to the East Coast, and because it's always kind of raining, so you're so used to it. But no, it's beautiful there in the summer times though. So I don't want to piss on it too much.
Yeah, no, listen, it's a fabulous place, and the music. You guys are like famous for your music scene. Would you have been too old to be at the clubs with? Yeah, too young. You're too young to be at the clubs with Nirvana and that whole scene, right?
No, but small story. My aunt sold pot to Dave Grohl. She was his pot dealer, so there's a connection there. Huge fan of course, of all the grunge great bands in that era.
Oh, that's hilarious! Your aunt, Dave Grohl's pot dealer. I think he's probably moved on though. Okay, so listen, why don't you tell us a little bit about yourself, how you got into the industry, just a little of your backstory would be great.
Yeah, so I'll be quick. I mean, so I grew up quite poor, about as poor as you can grow up in this country. Learned a lot from that process, but I didn't really know what the hell finance was. I think if you'd asked me what an investment bank was at age 18, I would have told you just a bigger retail bank, or a retail bank with more ATMs. So that's that gives you a sense of like the lack of knowledge I knew and really had about the industry. But in terms of how I got into college, I went to Yale as an undergrad. So this is maybe 2008 when all my friends who had done internships at, the big banks, they weren't getting called back. They weren't, getting offered and stuff like that. People obviously losing their jobs. I'm this idiot, stud on the football team, not even realizing like that was an issue. And as a quick backstory, a quick aside, when you go to a place like Yale, this is pre-2007, you kind of just knew in the back of your head, someone's going to hand you a 6-figure job when you graduate. You typically don't have to do too much work to get to that seat. But obviously everything changed in 07 and 08 was part of that process. So At any rate, nobody was getting jobs. All my friends were getting pissed and everything. And I just happened to see Keith McCullough, who runs Hedgeye, puts out this ad in the YDN, the Yale Daily News, a full page ad, like in the middle of the financial crisis, like, hey, we're hiring, come to, 111 Whitney Avenue and drop off your resume. And so I proceeded to do that and was one of the first classes of analysts at Hedgeye, and the rest is history.
So what was it like going from the West Coast to the East Coast to play football? And you mentioned to me that you have a good admission story. I'd love to hear it. Oh
my God! So if you grew up in Seattle and you're a great football player, as I was, your goal is to play for the University of Washington Huskies. Great, proud, rich tradition. Former national champions, things like that. So. I'd always had in the back of my head that, once I got good enough and I started getting scholarship offers that, I would play for the University of Washington. They started recruiting me pretty heavily my senior year. And, in that process, Yale and the Ivy League schools start knocking at the door. My high school coach sent my tape, and this is for all the Gen Z, young millennials out there, sent my VHS, Google what a VHS is, sent my tape to the Ivy League coaches, and Yale sort of really took a liking to me. And so they started recruiting me, and, their coaches would fly out and, come visit me in my high school and whatnot. And, they recruited me pretty hard. And I realized like, this is kind of pretty deep in that process. And my friends are all asking me like, okay, we keep seeing all these different schools, but who's this Yale school? I'm like, oh, I don't know. It's like some small school in Connecticut. They don't even have scholarships. Like, I don't know why they keep coming out here, but like, I got to tell the guy no next time he gets here. And so anyway, like that's my mindset, because I didn't know any better. We didn't have the internet, our lights were off like half the time, we're in and out of like homeless shelters and stuff like that. So I just didn't have the frame of reference to understand what a life-changing experience that could be. And so long story short, my AP marine biology professor, Craig McGowan, he also was the head of marine biology at the University of Washington. Okay. And so there was some sort of program where, he could teach a class at my school. And, he pulls me to the side after my final, the first semester, senior year of high school, and goes, so, like, what schools are you looking at? What do you think you're going? And I'm like, oh, yeah, like UW's about to offer me. Like, I'm definitely going to UW. Like, I'm getting all this other looks and stuff. But, it's non-scholarship stuff on the East Coast and stuff like that, things like that. He goes, yeah, I saw, Yale's recruiting you. I'll do you a favor, kid. I'm going to make sure you don't go to UW. If I were you, I would just go to Yale. And that's when it all clicked. And, it kind of was like, oh, like, this is a really good opportunity. This guy isn't just blowing smoke up my ass in terms of how good this opportunity was for me and my family. So that's kind of it.
Oh, that's terrific. So you went to Yale, and then the rest is history. I was asking when you earlier. I was kind of joking with you and said that you went to Yale, and you mentioned that you grew up without a rich dad that was buying a wing to get you into Yale. And I thought either he's a genius or he's a scholar, an athlete of some sort. But the reality is that you also need to be really smart to get into even on the athletic program. And I'll just tell you, my brother played hockey, and he got a scholarship at University of New Hampshire. Great school, great Division I hockey school. But the funny part about it is that when he was getting recruited, they came around, and Brown came around and wanted to recruit him until they had to look at his marks. And then it was all of a sudden like, we're not going to take you. So I know that it's not just your football that got you into Yale. You must have been awfully smart as well. Okay, so let's talk a little bit about your the 42 macro process. I'm not familiar with it, so could you just walk me through the basis of how you think about the markets and the kind of the genesis of your, let's just say, product?
Yeah, thank you. I appreciate that intro. I'd say 42 macro, the number one thing we do well and really help investors with is understanding what regime the market is in and trying to price in. And I think the second thing we do well after that is trying to forecast what the next regime might be. And so we do that through sort of a rate of change lens of understanding, the trending rates of change of growth and inflation, forecasting those and understanding how those deltas have historically influenced asset market performance, both, within and across asset markets. And then ultimately identifying and now casting what regime we're in and ultimately measuring and mapping how that might change in the near future.
Okay, so why don't you tell us about the different what do you call them? The regimes, the different regimes that, I see that there's 4. Why don't you walk us through typically what each one looks like and how it works? And then from there, I'm really curious in terms of how you determine when we're moving from one to another.
Yeah, that's a great question. So, so some of your listeners might be familiar with me from my old seat, where I was a sector at macro at Hedgeye for a long time. Shouts to my colleagues there. Appreciate you guys. On slide 4 in this deck that I sent you guys, and hopefully you guys are making it available for your listeners. I have this stylized diagram, just sort of identifying, how we think about this regime segmentation process. If you marry the two factors, growth and inflation, which are the number 1 and number 2 principal components for most asset class returns, you marry those two factors, you wind up with 4 distinct states in regime segmentation space. So the upper left quadrant there, that's Goldilocks. That's where growth is accelerating and inflation is decelerating. That tends to be the most positive regime for equity and credit market performance relative to more, risk-off type assets, safety assets. The upper right quadrant, that's reflation. We call that reflation, or GRID. That's where growth and inflation are accelerating simultaneously. That's risk on, but with a more inflationary bias, you tend to see the outperformance of cyclicals relative to defensive, things of that nature. When you go south of the horizontal axis on this chart on slide 4, that's when you start to get into risk off. That's where growth's decelerating. When you're to the right on that, that's where growth's decelerating and inflation's accelerating. That tends to be quite negative for equities and credit. You have certain pockets of the commodity space can still work, like energy, natural gas, but generally speaking, you tend to be risk off there. And then lastly, we all know the big D, the deflation. That's where growth and inflation are slowing simultaneously. That's where asset markets are effectively forcing central bankers to get involved and start to reflate again. So, this is how we think about the world. Everything we do is in the context of understanding, measuring, and mapping where we might be, both in the U.S. and in all the global economies, which we show on slide 5.
So there's no discretion in terms of determining which quadrant you're in. Is that correct?
What do you mean by that? I'm not sure.
Like, this isn't you looking at it and saying, I think central banks are tight, and therefore I see that this is going to happen, and therefore I forecast that we're in this regime. This is more you looking at the actual output of quantitative metrics and saying, based upon these, right now we're in this regime. Is that correct?
Yeah, that's very correct. So let me take a step back. That's our econometric process. This is how we anticipate how the weather will change. And to your point, we do that using our proprietary forecast for growth and inflation for every economy. Zooming into the U.S. economy specifically, you can see our growth projections on slide 25, our growth nowcast on slide 26, our inflation projections on slide 27, and our inflation nowcast on slide 28. We do that same process for every economy. So that's our attempt to forecast what the weather might be. Okay. I think it's equally as important as an investor to orient your risk management with respect to what the actual weather is. And It's no different than dressing, right? Like if you're going to the beach, you can't just say, hey, it's July, I'm going to put on a bathing suit and sunscreen, and go to the beach just because it's July. You still have to check the weather and make sure that it's not raining, it's not high tide, you're not in the middle of a dang hurricane. And this is where our global macro risk matrix comes in, which is featured on slides 7 through 11.
And with these regimes and calculating where you are in the regimes, can I ask? I'm not going to, if this is a proprietary inputs, I'm not going to ask you to name them all. But could you tell us roughly how many there are? What are the frequencies? Are they market based? Are they more economic based? Just a little flavor of what's going into that determination of what quadrant we're in.
Yeah, so it's actually interesting you asked that question because I get to the same answer in one of two ways. So the frequency with which the regimes change on a bottom-up basis, i.e., what the economy is doing in realized data terms with respect to growth and inflation, and we use OECD composite leading index data for growth and headline CPI for inflation because those things backtest the best in terms of predicting and dispersion, asset market dispersion. But in terms of the market regime nowcasting process, it has the same frequency of change. And the reason for that, in my opinion, is because asset markets are trying at all times to price in the trending rate of change of growth and inflation because, oh, by the way, the trending rates of change of growth and inflation really have an impact on the changes in policy, changes in monetary policy, changes in fiscal policy. And if you keep hearing me say the word change, it's very deliberate. Change is the most important factor in markets. You need to be able to forecast, predict, measure, map change.
Yeah, I can't tell you the number of times people will say like, "Oh, but the Fed's accommodative. Why are stocks going down?" And you'll be like, "Because at the margin, the Fed is withdrawing liquidity, and it's not that aspect." Now, a quick question along that way: how do you account for the idea that the markets also not only is the rate of change important, but how much is priced into that kind of the market anticipating rates of change or changes in rates and change? Do you take that into account, or is it more that you find that on the whole, avoiding that is fine because sometimes they'll be ahead, sometimes they'll be behind, and just getting the bigger picture over the longer term is more important?
No. It's the former. We spend a lot of time measuring and mapping and trying to understand exactly what is priced in at any given time. And so, if you look at slide 7, one of the reasons, one of the things we do at 42 Macro is sort of knock on the door of the 42 most liquid, most widely followed asset market exposures in the world through the lens of our volatility adjusted momentum signal process. And by knocking on each of those 42 doors every single day, we can get to slide 8, which tells us, hey, generally speaking, asset markets are pricing in X, Y, or Z with respect to Goldilocks, reflation, inflation, or deflation regime.
Can you give me an example of how you would use that right now, like a current example?
Yeah, exactly. So right now, you look at on slide 8 in this deck. Right now the overall conviction score in that regime, in terms of all the total signals that are of all the markets that are pricing in one or more of those regimes, we're only in the 7th percentile of that time series going back to 1998. And so that tells you that asset markets are very, very neutral. There's a low degree of conviction with respect to pricing in any regime. And that's sort of featured on slide 9. If you see slide 9, you can sort of see, hey, look, we were in this massive reflation trade, heading into the beginning of 2020. Then that was followed by a very massive deflation trade, kind of in February through March. Then that was followed by a very massive, Goldilocks trade from like, let's say May through August, September. And then October, November onward, it started to be a massive reflation trade. And so to answer your first question, going back to slide 8, at the peak of the reflation trade in early June, and this is something we called out in real time, we said, hey, look, we're at a 99th percentile conviction score with respect to reflation being priced in. And that likely implies investors are fully priced and fully positioned for reflation. And so if we have anything change at the margin, you're going to see some pain with respect to that crowded positioning. And so that's how we use this process to front run those big moves in markets.
Oh, that's fascinating. So when you say that you were the 99th percentile, that has to be more than just sentiment. How many inputs are going into determining that?
Yeah. So going back to slide 7. So again, it's each of those 42 markets has a say in what percentile we're in. And so if all of the 42 markets are saying, hey, one grid regime, it's reflation, deflation, Goldilocks, or inflation, then we're going to be in, close to the 99th, 100th percentile. If none of the markets are saying anything, or if they're all netting themselves out to say nothing, then you're going to be in a low conviction score.
So does that mean, so just so I understand that, so like one of them is the CRB raw industrials. So at that point you saw it, actually that's just blank. So maybe that's not a better example. Or wait, I'm looking here at this June. Oh, because this doesn't go back far enough. But at the time you would have seen greens across the board in a lot of these ones that were specific to confirming that. Now, but some of them will be different, because if bonds are showing that, that's different than if the CRB is showing that. So you must have, they must go into different categories for your model.
Yep. And each of those markets on slide 7 are, in terms of how they contribute to the regime scores on slides 8 and 9, they are their contribution to the regime score is a function of how the asset market has historically behaved in the regime. And so we've back tested every single asset class, every asset market, every sort of liquid market exposure with respect to its, annualized expected returns, its percent positive ratio, its volatility and covariance with equity beta with respect to those regimes. And so we understand and really use that understanding to, sort of measure and map all those market regime signals that you're seeing on slide 8.
So you had to be the smartest guy on the football team, Darius.
I'm not even sure I was the smartest O-lineman. We have guys who are clerking for Supreme Court justices and stuff, man.
Okay, so why don't we go on and start talking about what your models and your these different regimes might be telling you right now? What other kind of stories are catching your interest, or what would you like to highlight that your research is showing right now?
Yeah, absolutely. So I put together a summary of everything I'd like to hit on. I don't think we're going to have enough time, but there's 5 sort of topics, and we can go through them in order. And if we run out of time, we run out of time.
Sure.
So number 1 is I see a mini reflation trade developing. Won't be the same kind of reflation trade we saw from, let's say, November through June. However, I do believe this is, we could have a decent Q4 with respect to some of the signals that we're seeing. Number 2, downside risk number 1 of that is mismanaged Chinese deleveraging process. Downside risk number 2 to that, supply chain disruptions really sort of stymieing and putting a lid on potential growth. And then 4 and 5, and this is something that's, kind of, this is discussion that's making the podcast circuit, so I don't want to be too additive to it, but inflation, whether it's transitory or persistent, I happen to believe that it's both. It's transitory in rate of change terms, but it's likely to be persistent in levels terms.
Sure, let's hit these. Let's start with the one that you see a little mini reflation kind of jump here in the near future. Why don't you define when you say mini, and why do you feel that?
Yeah, so the reason I say mini is because, going back to, early part of November of last year, we were making the call, and this is, my hedge I see saying, hey, look, this is going to be the deepest quad 2 move ever. The deepest quad 2 move ever is going to perpetuate the deepest quad 2 kind of asset market dispersion. You're going to see the worst sell-off in bonds ever. You're going to see the highest outperformance of cyclicals ever. You're going to see things like Bitcoin go to 100,000. We were off by 35,000 on that call. Still got some time, I think. But anyway, I don't think that's the case. We don't have the economic setup, the backdrop rather, in terms of the deltas that we're going to observe in growth and inflation on a go-forward basis to perpetuate those kinds of asset moves. However, if you look at slides 16 and 17 with respect to what we're starting to see develop, high beta, low beta ratio looks like it wants to break out to bullish. Same with the small cap, mega cap ratio On slide 17, you look at value to growth. That certainly looks like it wants to break out. And then lastly, slide 18, I confuse way too many people with these charts, and that's my apologies. I need to find a way to communicate better, and I'm working on it. But the chart on the left on slide 18 just shows the volatility risk premium at, in terms of how we calculate it, 30-day forward at the money put implied vol relative to our rough estimate of the volatility surface relative to where realized volatility is trending on the x-axis. And consistently we've been climbing a wall of worry, and that's really it's increasingly become that we're crowding into shorts, not we, but investor consensus. And so the market is starting to get to a place where it's really ripe for a short squeeze. Now, it's not quite there yet. I would argue we need to get through the October 15th OPEX catalyst before we're fully there. But the most important chart on this slide right now is relates to the mini reflation trade. And again, we're on slide 18, is the dispersion analysis on the right. The dispersion analysis on the right, you got 70, 80% of the upper quintile constituents are cyclical. And this is a very marked shift from where we've been really throughout the summer, whereby 70, 80, 90% of those upper quintile constituents were defensives. And what I mean by quintiles, there's 50 U.S. equity sectors and style factors represented in this month-on-month Sharpe ratio dispersion analysis. So we're looking at the upper quintile versus the lower quintile and seeing what's in it. And that's a big shift from what's just changed. This is kind of the shift we saw going back to October of last year. You look at late October, market was very weak. We were in the second of a 8+% correction, in back-to-back months. But you saw that was the first time for a while that we saw cyclicals really start to lead, and I think that's sort of the similar setup that we have today.
Darius, you've been talking about cyclical leadership. What do you think's driving that?
Yeah, so I mean, clearly the Delta had an impact on growth. It's our view that as the rest of the U.S. and global economies really start to move past the peak impact of the Delta variant from an economic perspective, that growth is set up to bounce again, particularly as we start Q4 here. So I think we're going to start to see some better leading survey data for the month of October, likely in the month of November. That should be followed by better hard data on the lag. But to me, I think the real big setup is the liquidity factor. And this is something like, I think with respect to the debt ceiling and all this other stuff that we, kind of have to wade our way through over the next few weeks, people are forgetting the liquidity factor has not really changed that much. You just look at slide 89 in this deck, cash on the sideline is still really high. We're talking about $4.6 trillion. On slide 90, we've seen this movie before with respect to investors crowding in on the short side in terms of overpaying for put protection, into the later stages of a bull market rally. And that has historically been very positive in terms of dealer flow, unwinding and perpetuating higher highs. And the real main event, in my opinion, is on slides 91 and 92. 91 shows our estimation of the net liquidity being provided from the Fed and the Treasury, the Fed balance sheet minus the change in the Treasury general account. And, that continues to be through the roof. Tapering is not going to really put an end to that. But I think a lot of investors are concerned about slide 92, which is, once we get past the debt ceiling and we push this big budget resolution package back, the bully that is the U.S. Treasury market in terms of public debt issuance and taking money out of the system is going to come back and come back with a vengeance. It's obviously been kind of nowhere to be found all year. And that increasingly looks like it's not going to be the case. You just watch these discussions with Biden and Senator Sinema, Senator Manchin. We're not going to get $3.5 trillion on this budget resolution. It could be $1.5 trillion. Now, I would argue 2 is probably a nice Goldilocks sweet spot in terms of not being too low for people who are, levered long, Peruvian mining stocks. But, 3.5 trillion is probably too high for people who are levered long digital economy mega cap thing names. And so you get a reasonably sized number that doesn't spook the market in terms of the forward outlook for Treasury issuance. And then we have additional scope for the blue line on slide 91 to continue higher, albeit at a slower pace.
That's some fascinating stuff. Okay, let's move on to number 2. Mm-hmm. China mismanagement. And I guess you're talking about more than just Evergrande, but I'm sure that's part of it. Why don't you walk me through what you're thinking there?
Yeah, of course. So on slide 87 in the deck, we show Chinese credit impulse relative to commodities. And, historically speaking, Chinese credit impulse, you're talking about a 3 to 4 or 5 year periodicity, peak to trough. So we're getting close to the trough in terms of where it's bottomed historically. But the problem is that this is not sort of a traditional cyclical cycle in the sense that there are real policy initiatives driving downside here. We just don't know. It's hard to know as an investor ex ante where the ultimate sort of downside protection is where the strike price is with respect to the China put, the Beijing put rather. And so on slide 88, we show the blue line, which is 3-month Shibor. 3-month Shibor we track as a proxy for Chinese monetary policy impulse because 82, 84 at any given point in time percent of all private non-financial sector credit on the mainland in the mainland economy is on bank balance sheet. Like that's astronomically high relative to an economy that size. I mean, like for example, the U.S. and Europe are somewhere around 50 or below 50. U.S. is around 47%. We have a big non-bank shadow finance sector. China does not. Everything's on bank balance sheet. So if you track interbank lending rates, you know exactly what the impact of the PBOC's monetary policy setting is having with respect to financial intermediation.
Once again, I don't mean to interrupt there, but that's a fascinating kind of point, Darius. That if you'd asked me who has the bigger off balance sheet stuff, I would have immediately said China. And you're saying that it's all that most of it is on the bank's balance sheet. So therefore, when we're seeing the Chinese rates, they're having a direct effect immediately to that part of the economy.
Totally.
Okay, now the trouble is that I guess one of the issues is that it's not just a liquidity issue; it's also a kind of a fundamental change in what Xi is trying to accomplish. Now, what would be your sign that the coast was clear from the Chinese on the Chinese side?
Excellent question. This is exactly why I have slide 88 here in this deck. Historically speaking, we've seen the Chinese authorities panic when growth gets too slow. And the reason for that, and you can see the panic as denoted by the black dotted lines on slide 88, which are coinciding with, big easing initiatives. The Shibor rate goes down by 200, 300, 400 basis points at a time over a short time frame. And, it's clear that they're easing and panicking on the monetary policy front. We're not seeing that today. As slow as Chinese growth has become and as really clouded and murky as the outlook has become, we're actually seeing Shibor tick up. And so it's telling you that their commitment and their resolve to maintain this neutral policy, and I take that as an extension to maintain this sort of initiative, this common prosperity initiative, is actually quite high, right? Like to me, they're seeing the forest through the trees, and we as investors need to understand that and stop seeing the trees and recognize the forest. And so the reality is Chinese growth is not set up to rebound meaningfully anytime soon, because historically you've needed to see the credit cycle inflect in China to see the growth cycle inflect. And, it tends to lead the growth cycle by 6 to 12 months. And we're not even close to a bottom in the credit cycle if this analysis on slide 88 is anywhere near correct.
And so what investment kind of conclusions do you draw from that?
My number one investment conclusion is that you don't want to be too far out on your ski tips with respect to betting on a reflation trade. Now, again, I started this presentation by saying, hey, I think a reflation trade is developing. But I also said, hey, look, I don't think it's going to be like the one we saw, from November to June. You don't have that kind of scope in terms of the amount of months you have to price in an acceleration of growth and inflation. You certainly don't have the backdrop with respect to, a Chinese credit cycle that could be potentially supportive as well. If anything, it's moving in the wrong direction. So I think the coast is clear from the perspective of inflation, but this might just be like a 2 to 3 month, maybe 4 month trade at most in terms of being able to profit from, kind of the peak of this bull market.
Okay, so let's move on to number 3, which is somewhat related to China, but it's actually much more. The supply kind of chain management. We're seeing more and more problems all around the world. What do you think is driving that, and what does that mean for investors?
Yeah, so if you look at slide 74, we show ISM prices, indices, prices paid for manufacturing and services, and they're off their highs. But if you draw a straight line back from the most recent data points to the left side of the time series, it's very clear that we're still in very elevated conditions. If you look at slide 75, we show the Baltic Dry Index relative to 2-year break-evens. And Baltic Dry is still making highs. 2-year break-evens are very much still at their highs. So what we're saying here is, look, past peak supply chain disruptions are, does not mean there are no supply chain disruptions. And you actually might see them accelerate if you think about the energy crisis in Europe, kind of spilling over into the broader global economy, through the lens of rising crude oil and natural gas prices, which, by the way, we're both along both of those assets. On slide 76, it hasn't really impacted earnings that much yet. But on slide 77, if you look at the sort of second and third derivative of the chart on slide 77, which is, Russell 3000 cyclicals, next 12-month earnings expectations, they're actually starting to very marginally tick down. And I certainly think, as we get through and progress through Q3 earnings season, we actually might get a reset of earnings growth expectations on a next 12-month forward basis. And the reason for that is, look, you're hearing it from Micron with respect to semis. You heard it from Nike with respect to selling people, $150 shoes. You heard it from Blood Bath and Beyond with respect to selling people shit they don't want in their house. Look, the supply chain disruptions are having an impact on the economy. You can see it on slide 78. 78 is like showing auto sales. It's like we can't manufacture enough cars to sell people.
Right.
And that's obviously, these auto sales down in the most recent month, down 80% annualized.
Which brings us to the next question, which is inflation. And you said it's both transitory and kind of secular. Why don't you walk us through your thinking there?
Yeah, so this is, to me, this is the key debate of the day. And I do believe we should spend some time, kind of unpacking, both the transitory and persistent categories. So I'll start with transitory. Slide 27 just shows our inflation projections. Again, we run two separate models to project growth and inflation, 42 macro for every economy. The same models, just different, obviously, inputs. But both models are saying, hey, look, inflation's coming down on a rate of change basis over the next 12 months. That's slide 27. You look at slide 50 in terms of where we kind of started at the pandemic with, the next series of charts will kind of walk you through what we're thinking on that. Slide 50 just shows our analysis for demographics. I won't, I don't want to unpack the chart on a podcast. I'll let the users or the listeners kind of dig into it themselves. But the reality is our demographic situation hasn't changed. Slide 51, the secular drivers of disinflation are still intact. You look at, the dominance or the decline in the labor force participation rate, which is accelerated to the downside in COVID. You look at the decline in money velocity, which is accelerated to the downside in COVID. You look at the dominance of technology and the proliferation of the digital economy space and all the disinflation that comes with that, accelerated in COVID. And then the only thing that is not accelerating in COVID, but is still pretty elevated, is, sort of globalization. And we sort of use the imports of goods and services as a percent of GDP as a proxy for globalization. None of those things have changed materially. And if you add it up on a net basis, it probably means there's more disinflation in the economy. And if you look at slide 52, I would argue it's kind of saying the same thing. Some of these longer term drivers of disinflation. The blue line on slide 52 shows the market cap of the S&P 100, the 100 largest stocks in the S&P 500 as a ratio to the 500, the broader index. And that's up and to the right, through COVID. And that's telling you that, monopsony power still is very much intact in this economy. In so much that the red line shows the employment, the ratio of employment relative to consumption of fixed capital or CapEx is down to the right as well. So, businesses still have bargaining power. They might not in this, particular window of time where everybody's rushing to buy over order goods, get ahead of the Christmas rush, things of that nature. We're living in this very, hot inflation moment, but none of this stuff has changed with respect to the longer term outlook in inflation. And that to me is why you're seeing slide 53 through kind of 57, 58, you're seeing inflation momentum start to wane, even as we keep yelling, shouting from the rooftops about inflation. Headline CPI is waning on slide 53. Look at the bottom panel of those charts. Core CPI momentum has been cut by 90% from its peak. Airfares, used cars, all that stuff's down, and ultimately core PCE momentum is decelerating as well. So that's my kind of longer term view. It's like, look, unless you tell me something has materially changed, you have to respect and acknowledge the base effects in the time series and the rate of change of the time series. Now, we alluded to this, Kevin. I say that to say this. That doesn't mean we're going to bottom at the same levels that we have historically bottomed at in previous cycles. The stationary, and this is about the nerdiest thing I'm going to say on this podcast. And mind you, to your listeners, I'm two glasses of Whispering Angel deep here.
So that's right. We actually you should take a moment to we didn't talk about the fact that you are a true huddler. You brought your own booze, and what are you drinking?
I am drinking only the finest, crispest rosé from Provence. My good friends at Whispering Angel, they should sponsor me in my life because I've probably given them as much business as anybody, certainly through my marketing. No, I learned in my old age that I can't drink beer without getting hungover, so I switched to Whispering Angel, and it makes me able to wake up at 4:30 in the morning.
And that is a rosé, right?
Yes, it is.
Okay, so absolutely. Lena, hop on. Lena usually doesn't get on for the guests, but she's getting on now.
Sorry, I was
Lena.
already.
There we go.
Lena,
she's
up?
there.
What's up?
Lena,
Yes.
What is rosé?
Cougar juice.
Cougar juice. So
all my cougar friends love rosé.
Lena, you unpack. You just open up Pandora's box. So, I this also I'm 34 now. At 30, I was probably extremely attractive. According to several sources, not myself.
Your mom?
I could not walk. Yes, I'm sure she thought that too. Anyway, I could not walk into a room in New York City without any woman above the age of 40 to 45 throwing themselves at me.
See,
And
there
I don't
you
know
go.
what it
They
was.
knew you loved rosé.
They knew it. It's cougar juice.
They could smell it from miles away.
Yeah,
They
no,
could
that
smell
was
it
it. It
from
was
a
the
mile away.
pheromones or whatever.
Oh my God! All right, sorry. Let's get back to inflation. This is where.
Thanks, Lena. So tell us now. You're going to tell us the secular story of inflation.
Yeah. So to me, it's really about the stationary mean of the time series. So let's go back to where we started the inflation discussion, back to slide 27. And if you look at the left chart on slide 27, you see that there's, pretty, at least past the, basically since the post-crisis era, if you look at headline CPI in particular, which we're denoting on this chart, the stationary mean of this time series is somewhere around 1.5%, right? Give or take. I think that number is probably closer to 2.5% now. We won't know that as investors until we start to realize data in the latter part of 2022, when the red line in the chart on the right starts to bottom at a level that's much higher than 1.5% or lower than 1.5%. And the reason I say that is because, I think a lot of your, guests in recent past, Lynn Alden's done great work on this. A lot of people have done great work on this. And I tend to think that, I'm not too far from their conclusions, which is, look, the fiscal policy dynamics in the U.S. economy have changed. And the reason they've changed goes back to my brilliant colleague, Neil Howe at Hedgeye, one of the smartest people in the world, by the way. If you go to slide 42, we show on this chart, the x-axis is the Gini coefficient. It's a measure of income dispersion. Higher is more unequal, less is more equal. And the y-axis shows the unemployment rate. And you'll notice the location of the U.S. dot relative to all the other economies, OECD economies and major emerging market economies on the chart. And you realize, hey, our peers are not like Germany, France, UK, Japan. It's China, Russia, Chile, Mexico. We're not as far out as Brazil, but I mean, it's very clear that from the perspective of political risk through the lens of populism, the U.S. has become an emerging market economy. And the reason for that is on slide 43. The red line on slide 43 shows corporate profits, which is the mother's milk of equity markets, according to Larry Kudlow.
I was going to say, you're channeling your deep Larry
channeling
Kudlow.
my inner Kudlow. The blue line shows employee compensation as a percent of GVA, which is the broadest measure of income. And so you see that there's a very stable, it's cyclical, but there was a very healthy, stable relationship with respect to that, prior to 2000. And that was the social contract. You worked, you got paid, you could buy a house, you could afford to send your kids to college, and, you could afford to, bury your parents and, go on and so forth. That was kind of the American dream. Ever since 2000, the American dream has been a lot closer to what I realized as a child than it has been to what, what I'm realizing as an adult, which is everything is too expensive. And it's really as a function of your wages can't keep up with the productivity and the earnings growth of the economy and ultimately the price level of all the goods and services people need to procure. And so, part of the reason for that, obviously, if you think about kind of what happened at the turn of the century, China joining the WTO in November 2001 was a major factor in terms of outsourcing a lot of our productive capacity. You had the repeal of Glass-Steagall, which led to the proliferation of the private equity industry and all the industry consolidation as a function of that. But then you also had, in terms of, the digitization of the economy and all the disinflationary impacts from there as well. Like you just don't need as many people to do stuff, right? Like I have a 101 page presentation with, a bunch of fancy models and stuff that probably take a team of 6 or 7 economists and macro investors to put together like 20 years ago. I'm sitting here as a guy in a room on Zoom, doing this by myself now. That's a great microcosm for how disinflationary, the changes in the economy have been for labor. And so that kind of takes me to my next chart with respect to why the stationary mean of inflation is likely to transpose itself higher. You look at slide 44. This shows the x-axis, the current account balance as a percentage of GDP. The y-axis shows the sovereign fiscal balance as a percentage of GDP. And you can, again, we're like an outlier, the United States of America. We're like panicking as a response to COVID. with respect to our fiscal policy response. And it's not just COVID. It's the politicized zeitgeist in the economy that we've been getting screwed. Not we, but, people like, where I grew up, my friends, family, we've been getting screwed this whole time. So you better throw some big bucks at the situation. And the reason we think they threw big bucks in the situation, and again, it's bipartisan. This dynamic is bipartisan. We saw Black Lives Matter protests in the middle of summer 2020. We saw, I don't know what they call themselves, Trump protests in the nation's capital in January 2021. This is not a political thing. This is a bunch of poor people who are freaking pissed off at the system not working for them. And so ultimately, our fiscal policymakers are now debating whether or not budget deficit should be $2 trillion versus $1 trillion, as opposed to $500 billion versus $1 trillion. And that's a big deal long term. And it's a really big deal because on slide 45, we show that foreign central bankers don't really want to hold our debt at the margins, which means the Fed on slide 46, this is the Fed balance sheet as a percentage of total public debt outstanding, the Fed has to be called on to replace that gap. And if the Fed doesn't replace that gap, then guess who has to freaking pay for it? We do. Investors.
Right.
We have to pay for it. And so that's just, to me, this is why the market on slide 48 had such a negative response to the June FOMC catalyst in terms of the hawkish dot plot revision, because it was the first signal. Go back to Jackson Hole of August 19, or not August 19, August 2020. The Fed basically, in so many words, they basically said we're kind of on board with M&T, kind of. They said, okay, we're going to give average inflation targeting. Right. We're going to give you, we're going to give you a maximum. They're going to try to fix racism with monetary policy in terms of maximum inclusive employment. And so we basically thought that the Fed was had adopted an M&T framework prior to that meeting. Well, since that meeting, you saw, things like terminal Fed funds rate expectations, break-evens, interest rates, all the stuff went straight down because that was the first signal for investors that, hey, look, this Fed might not actually let the economy run as hot as we thought they were going to do. Well, that kind of changed again, and kind of this is bringing the conversation full circle on slide 49. You see that, this is showing euro-dollar calendar spreads, and, the red line is 23 and the black line is 24. The black line is the most important line here. It's bottomed, and it's now starting to rise, and obviously all these lines are rising after the September FOMC when the Fed effectively said, no, I think we said too much in June. We're going to have above target inflation as far as the eye can see. And, oh, by the way, you're going to see the slowest monetary policy tightening cycle in the history of U.S. economy. And right. So I think they're getting back towards that M&T framework, but it's not as aggressive as it was, kind of at the peak of the inflation trade in early June.
Well, it helps when two of the big hawks got kicked off for trading their own account.
Jesus, yeah.
Okay, Darius, let's ask. I'm going to shoot you some questions. I did not give you the warning, so you're going to have to, figure out if you can do this on the fly. Let's start with the idea. You've talked to a lot of investors throughout the years, institutional, retail, a lot of different people. What do you think is the biggest mistake they make?
Ooh, biggest mistake they make. I think people get overly focused on the destination. And this happens both institutionally and it happens with retail, because I think it's really just a function of our cognitive biases and our preference for narratives. People get overly focused on the destination and they forget about the sequence. And this is why, going back to our very initial conversation about, okay, we have this regime process and we're trying to measure and map and forecast what regimes we're going to be in on a kind of a rolling next 12-month basis. But the reality is, you go back to slides 7, 8, 9, 10, and 11. Look, I could be wrong on that. The sequence could change. There could be this thing called COVID. There could be this thing called the global financial crisis. There could be this thing called the debt ceiling. We don't know what those things are ex ante. It's impossible to know. We can spot vulnerabilities as to our best of our abilities, and we do that through a variety of lenses, if you guys want to look throughout the deck. But the reality is, sometimes the plans change. And, my high school football coach had a great saying about this. If you ever seen like a high school football practice, it's usually not enough people to go like one-on-one or, team on team in every drill. And so you use things like bags or, trash cans to kind of, mark where the defender or the offender might be standing. And my coach would always say, hey, look, when you come off the ball, don't just walk, or, we're in walkthroughs. Don't just walk straight to the trash can. Take the angle that is going to get you to where the trash can is going to be, when the ball is snapped. The trash cans move in real life. And that's sort of the key takeaway in investing. It's like, look, the trash cans move. you can't just go straight to the trash can. It's about, understanding how the trash can might move as a function of all the different things that are shocking the environment.
Well, that's a terrific. I love that. Okay, next question. Great traders, investors, are they born or made?
Oh, no, you got to make a lot of mistakes to become a great trader or investor. I mean, anybody who's done this seriously for a long period of time and has had reasonably good results will tell you they've made a ton of mistakes, and everything they know is a function of mistakes. I mean, to me, I've certainly made my ton of mistakes. If I could have an investment committee, I think I can generate 8-9% annualized returns on a market neutral basis. I need someone around me to say, hey, no, you like Bitcoin. Don't put 7, 8, 9% of your capital in Bitcoin. It's easy to do because you get caught up in the narrative and you get caught up in all that stuff. Again, that doesn't mean I don't invest with the own sauce. My portfolio construction, at almost every moment reflects what we're showing on slide 23, which is our portfolio construction. And so this is, but there are times where I'm like, look, I kind of like this a little bit more than that. Or at the bare minimum, I might get to new cash and like, hey, look, I kind of just want to make this position a little bit bigger because I think the next near-term catalyst might be. Those are all mistakes. Those are all mistakes. Stick to the process. Don't try to get rich quick. If you want to get rich quick, investing is the wrong business. I go sell dope or make a rap music or you know what I mean? Like, I don't know what to tell you. Like, this is the wrong business if you're trying to get rich quick. Because what people forget to realize is the x-axis on all these damn charts does not change, right? Like, we see all the wiggles and we see charts go straight up and to the right. We don't see all the wiggles. We see charts like the S&P 500 on a 5-10 year basis go straight up and to the right. And you go, oh, it was really easy to make money in that time. But anybody who's actually been sitting in the damn seat will tell you every single one of those wiggles was hard to risk manage, right?
Darius, I can't tell you the number of times that. So I grew up on the sell side on a prop desk, and I can't tell you the number of people that have said, "Oh man, I wish I was around when you were young because it was so easy then." And I was like, it wasn't that easy. Like there was a bunch of guys fighting for it, just like there's now a bunch of guys fighting for it. And I always say that there's going to be an equivalent guy like me at a bank somewhere that's kept his mouth shut, that's made a ton of money, it's going to have looked obvious and easy in hindsight, but it was actually very hard.
Very hard.
And I could. Okay, your favorite investment book.
Oh, favorite investment book. Oh, can I give you two?
Yeah, for sure.
Yeah, I can't distinguish them from one or the other because one formulates the basis for how I think about the world fundamentally, which is Thinking Fast and Slow by Dan Tversky Daniel Kahneman and Amos Tversky.
Okay.
And then the other formulates the sort of how I think about risk management, which is the Misbehavior of Markets by Benoit Mandelbrot. And if you kind of get the sense of what we do at 42 Macro, which is marry the top down with the bottom up. The bottom up comes from thinking fast and slow and understanding the impact of rate of change through the lens of prospect theory and why rate of change is the dominant force in asset markets. You think about the top down, with respect to the misbehavior of markets, volatility is a leading indicator for price. And this goes back to slide 6, which sort of outlines why grid works. Like, why does this Goldilocks, reflation, inflation, deflation regime, going back to, what I invented at Hedgeye, the quads, why does quad 1, 2, 3, or 4 work? The reason it works is not because I'm smart or Keith's smart or we're really smart. We are smart. The reason it works is because human beings are myopic, risk averse. Human beings need new information to gauge their feeling about certain investments because human beings like narratives. That's purely it. And so what we're trying to do is use math to front run those narratives.
Okay, last question for you. It's a doozy. If you could go back and meet the Darius Dale that is leaving Seattle and headed off to Yale and is about to enter adulthood, what advice would you give him?
Absolutely nothing, man. It's been a freaking beautiful journey, dude. I would not give him any advice because, again, like
you tell him to take up those cougars that were hanging out. That's what you do. You'd be like, give them a whirl. Go.
I really don't think I need to tell him that.
Okay. On that note, we'll say goodbye. So, Darius, why don't you tell people about your service, where they can find it? Give us the whole spiel.
Thank you, Kevin. I appreciate that. So again, we're 42macro.com. We got a little something for everybody. We put out 3 products. Lead off morning note. That's my daily note. Around the Horn Weekly. That's how we help investors risk manage through the lens of our portfolio construction every Saturday. That's a presentation. And then every month we put together one of these deep dive slide decks and all the puts and takes going on in the global economy and how we think investors should be positioned as a function of that. You could sign up for the service directly online, but if you're an institutional investor and you want, if you value my time and want to pay for that, we have a pro-to-pro consulting service as well. So check us out at 42macro.com.
Well, great. Well, thank you so much. It was a real pleasure getting to know you, Darius. I had a great time, and I look forward to doing this again sometime.
Kevin, man, you stay you, brother. You guys, you and Patrick are two excellent people. Lena, I appreciate the Cougar comment as well. So thank you guys so much for having me.
Take care.
So it's that time of month when Kuppy comes on for Kuppy's Corner. Kuppy, what part of the world are you in today?
I'm in Rincon, Puerto Rico.
Nice.
Enjoying the good weather.
Sure am.
Okay. So listen, you Kuppy, you had a piece that it's rare that I feel jealousy. I try to leave that feeling for others, but when I read this piece, I thought, damn, I wish I had written this. It was called "Will ESG Create the Next Lehman Moment?" It was a terrific piece. It was very much what everyone was talking about, on the words of a lot of people's, very plugged in folks were passing it around. I can tell you that. Listen, I just want to quote one section that I loved the best. And he says, these assholes actually have set out to destroy the global energy sector. Look, I'm all for using green energy. However, I'm a realist. You need to first, and he underlines and bolds first, build the green economy before you shut off the carbon economy. Going through the steps in reverse is bound to create an energy crisis, which may incidentally be the goal here. If carbon is unaffordable, everyone will be forced to pivot into green energy. Costs be damned. I'm a hedgie. This will be a minor inconvenience for me. It will cause chaos for most of society. Kuppy, when you read that, when you said it, it just seems so clear to me that you were absolutely spot on correct, that the fact that we've gone and made this step to green without building it first, and we've gotten rid of the carbon one before having a solution in place. Do you think it's going to cause a crisis?
I think there's a pretty good chance. I mean, look, America, we have a bunch of redundancy, but those fuckwits out in California already have rolling blackouts. The UK, it's dark, and what's Boris saying? Like, it's gonna be a 3-day work week because we have no power. It's starting to cause a crisis already. I mean, I bet you there's better, electricity reliability in Africa right now. And so maybe not Puerto Rico, but in Africa, definitely. So, no, I think it's already starting to cause a crisis. Look, I'm a trader. I'm not a politician. I mean, they broke it, and they'll eventually figure out how to fix it or break it worse. I don't know which one comes first, but when you start seeing these little kind of spikes all over the place, it's a warning sign that something is really wrong. And it's not that, electricity costs a little bit more this month. It's that there is none at any price. And I think it's a real warning sign that, look, I'm not against green energy. Don't get the wrong idea. I know that, 20 years from now, most of the world's energy is going to be green. I just realized that they're not ready yet, and they turned off the carbon economy. And,
right.
I think you're going to have a huge spike. I don't know if this is malicious, and I kind of lean towards that, or just stupidity, which is, never. What's the phrase? Never, credit.
Never attribute to malice what can be explained by stupidity.
Yes.
Yeah, it very much
it could be that too. But,
yeah,
I mean, so and I think it's a combination of both. I mean, we talked about this when I really started queuing in on this when the pirates hijacked the ExxonMobil. And I mean, these guys literally took over one of the largest energy producers globally and told them to stop producing energy. And, you kind of like scratch your head and say, how are they going to sustain the dividend or do the buybacks or do any of the other things? This is different from activism. Normally you go in there and you want to change the cap structure or fire the CEO or sell the company. Like, these guys have no desire to make money. It's a very different type of activism. And it really is a warning sign, I think. And, the question is how far this is going to go. And when you start seeing these rolling blackouts, you realize this has been going on for a while now, and it's game time for this. I mean, people have been talking about this for a long time, but it never really mattered because there was enough redundancy left in the system. So suddenly it's game time.
When you started talking about pirates, and at first I thought you were talking about Captain Phillips. That's what it feels like. You know what? I'm confused as well, because it seemed pretty clear to me that by starving the carbon economy, companies of capital and telling them that they're not actually, it's even worse than that. In a lot of cases, governments are telling them they can't do any more drilling, they can't do any more expansion of their reserves. It seemed pretty clear to me that the price was, headed higher in a lot of these commodities. Now that it heads higher, you see Biden begging Saudi Arabia to pump more. And I'm just like, wasn't that the goal? Like, wasn't the goal to send the price of these commodities higher so that these other green technologies could compete?
Yeah. I mean, I think they sat around in a, COVID room somewhere scheming this and saying, if we take oil to 200, green will be cost competitive and we'll do the transition. And then, as they go and do it, they realize that a lot of people have to suffer along the way. And, like I said, look, if it costs me $5 a gallon or $10 a gallon, like it's not going to change my life, but it's really going to suck for a lot of voters. And, Biden, he has midterms coming up. He can't go through this process really the way that they designed it, but he might be a casualty in 15 different ways along the way. But he probably doesn't even know he's president, so I don't care. But no, I think that you have a bunch of very plugged in people that want the price of energy going higher, and every step of the way, it seems that they're going to force it higher. And so I just want to be to the wall long energy. And, I think the corollary of that and the other half of my piece is that every crisis we've seen really since long-term capital, they've just flooded the world with liquidity. That was the solution. And each time it takes more liquidity to solve the problem. And what if there's a problem that liquidity doesn't solve? I mean, what if, they hand stimmies to everyone and, energy demand goes up? I mean, what if it's counterproductive in a way? And, what if the Fed panics and throws liquidity at it and just sends oil to 500? And, it's an inflationary shock that's, I think, going to start hitting the economy pretty soon. And it's supply based, not demand really. But what if they push on both sides and, you get this Lehman sort of thing? I mean, I'm kind of sick of people talking about that. I was almost hesitant to use the words because, Evergrande was supposed to be a Lehman moment. No, it wasn't. It's ring fenced, like everything every 3 months, it's a Lehman moment, and then it's not really a Lehman moment. Right. But this is the sort of thing where they throw liquidity at it, and it could really be a Lehman moment. Because, you send energy too high. Look, there's a bunch of companies in the UK that went bankrupt in the last month. And, you start having bankruptcies go through the system. You start blowing up people's hedge books. You start, companies say, I can't operate, with nat gas at whatever price it was. And, you really start creating big ripple effects to the economy. And the thing about Lehman was that, you'd wake up in the morning and you'd be like, oh crap, another subprime lender failed. And, who's their counterparties? What assets do they own? And where do they fit in this weird CDO cubed? And I remember in real time, all the news was bad. Each day was worse. I mean, if you have an oil spike each day, you're just going to watch, oil. It's kind of like the EKG of, the economy at some point. And that's just going to keep going up. And, I think you could wreck a lot of things. I think, honestly, the Ponzi sector is the one that gets shredded because inflation shreds it. And eventually the Fed's going to panic because the Fed is it's a political thing. Okay. And, eventually politicians are going to go to JPOW and say, your second term isn't assured. Do something about this. And the problem is that he has nothing to do with energy policy.
Right. He's not going to make us any more gasoline or find more crude or nat gas.
No, he's got like one knob, which is interest rates. And then he can kind of play around the edges with QE, which hasn't really worked. So he's looked at the reverse repos. It's just, it doesn't work anymore. It doesn't have any impact. And so he could do some creative stuff, but there's only so much he could do. And so he's going to do the only thing he can do, which is to jack up rates or, clamp down on liquidity with some QT. And it's probably going to create another crisis. I mean, everyone alive in the markets today, except maybe Art Cashin, came in after 1980. They don't realize that, in 1979 and 80, they jacked rates up and they killed the economy, and they jacked rates during a recession, actually. And they just kept making it worse and worse. I mean, imagine they start doing that, except for we're taking rates from 0 to some crazy number. I think it's just going to detonate everything Ponzi.
I don't even know how high the rates will get. before it causes problems. And then I don't know if it actually causes energy to come in. It just comes, financial assets or stocks just come in. As you say, you'll get the technology companies. And
take rates to 200 bips. I mean, I'm going to still fill up my car. It has no bearing whatsoever on me.
Yeah.
And, take rates to 500 bips and the entire economy freezes. So,
right. It really does. It doesn't change the demand of oil enough. And if that ends up being what's pushing it, it ends up being a very difficult problem to solve. I completely agree with you there. Okay, so let's talk about how you're playing it. Let's start, first of all, I know one of your favorite trades for the more sophisticated kind of futures users is you love the call oil spreads. And if anything, you're just adding to those. For, when we talk about it, you seem to be getting higher and higher strikes and getting more and more excited about it. Why don't you tell us about that?
So, yeah, look, I've been pretty clear on this. I think that part of the reason that oil goes up is because it's a really shitty time to be an oil producer. And it sounds counterintuitive, but you're an oil producer today, okay? You don't know what pipeline you're going to use. You don't know if your permits are going to be renewed, if they're going to be canceled, if you can get new permits. You can't really hedge because, look, go out 2-3 years. I mean, oil's in the 50s. That's below your cost of production. So you can't hedge, which means you're not going to, increase production. You're going to have carbon credits, and imagine oil's at 200. You're going to have excess profits taxes, and it's just going to be a very difficult place to maneuver around. And that's really where I don't want to be. I mean, part of the reason oil is going to go crazy is because these guys all get screwed. I just want to be in the physical. I think you're going to have a lot of inflation. I think your break evens on full cycle economics or half cycle are going much higher because what we haven't seen a lot of people talk about yet is that the supply chain's a total mess, and that all your suppliers are raising prices for the first time in like a decade. And so I just want to be in the thing that's going to break to the upside. I'm playing this with 2025 futures. I'm playing this with futures options. I'm playing this with call spreads. I've got a motley basket of strikes and various call spreads, and I probably should have funded it by writing some puts also, but whatever.
That is the true Texas hedge. I'm long oil, and I'm going to fund it by writing some puts.
Yeah, just sell some 50s to buy the hundreds.
That's right.
Oh my God.
But no, I mean, my favorite trade still is the 2023. I've talked about it a few times in your show now. The 23 December, the 90 by 100 call spread. You're long the 90s, you're short the hundreds. I'm doing this 1-to-1 ratio. I put it on at 65 cents. I put it on in huge size. It's a $1.10 bid right now, so I'm doing quite well on it. But I think it pays out at $10, and that's a 15 bagger. And I don't think any of these little shitty juniors are a 15 bagger from here. So you're basically taking a lot less risk. You don't have geology risk and permits. I got rid of all the dumb risks of all this thing. Maybe I have counterparty risk, but
you got no counterparty risk. That's that trades on an exchange. That's listen. If the CME is not honoring their trades, we have a lot bigger problems than the price of oil.
Sure, yeah, no, I know, but I mean, look, Robinhood almost failed. We learned that this week.
Yeah, but that's not a clearinghouse. You're fine. I'm gonna go out on the limb here and say you're okay with that. Okay, so are there any names that you actually do like in terms of the energy companies that you're be willing to talk about?
No, I mean, I don't actually own any producers. I got a little bit of my Sandridge left, but look. A year ago, I went on your show every month and said, this is free money. There's absolutely no way you can lose money. And it's really a question of if you'll make 5 or 10 times your money. And it turned out I made 10 times my money. And, I think it's got some legs still, but, I don't know. It's not very exciting. I wouldn't say at $13 you want to be laying into this.
Right.
I guess the thing I would talk about is I own a lot of Valaris. They're the largest offshore drilling company. I think offshore is going to come back. I think that if you look around what's happening in North America and you realize how difficult it's going to be to operate, you look at what's happening in a bunch of other places, producers are going to go to places without like laws or regulations or places that don't care about the environment. They're going to go to West Africa, and they're going to go to Guyana, and they're going to go to Brazil, and they're going to go to places that really just need the US dollar revenue because they have nothing else. And you're not going to do that onshore. You're going to do that offshore. And I think the company trades at like 15 cents on the dollar of replacement cost. And at the top of the cycle, it used to trade at 2 times replacement cost. And it's cash flow positive. It has a clean balance sheet. I don't think you really get hurt. And I think there's a good chance you make a lot of money. It's kind of the same setup with Sandridge. I don't know how much your money you're going to make, but I don't think I'm going to get hurt too bad. I mean, admittedly, my cost basis is 21. And we talked about this a couple months ago, and it's 35 today. But that's how I'm playing it. It's so
that was something that went through bankruptcy, cleaned up all the bad debt. And the reason it's trading so cheap is because everyone thought there's going to be no need to drill or do anything more like that in the future because we're all going to be green in a couple of years.
Pretty much. And then remember, a lot of the guys who got equitized, okay, this is a long bankruptcy. They had the debt. A lot of them in the 2-3 years that this has been going on, they discovered ESG, and suddenly, their risk officer is like, we own what? We own offshore drilling companies? Like, really? Like just fire sell, just sell it to Kuppy the first day, No, that's how I ended up picking up a whole lot of it, really, really cheap. But yeah, that's how I'm playing it. But mostly through my oils and my oil futures. I think that's the play the way to play it.
Okay, so just to recap, you're actually reducing some of your equity or energy equity exposure, and yet you're being even more bullish on the actual underlying commodity.
Right. And I mean, I have some other, service companies and I have bits and pieces. It's a big basket of this crap. But, that's, I guess, that's how I'm playing it. I mean, just going back to the macro side of it, I'm the Project Zimbabwe guy. And, I think we just, go higher, lots and lots higher. I also think a really nasty shakeout's coming along the way. And, if you look at, say, a broad index like the S&P, it might just do fine and power through just because, the energy component goes from, what is it, like 2%? It just goes to 20%.
Okay, so let's 1 second. Can I just jump in here to make sure that everyone understands? Yeah. You think energy is going higher, but you think that the stock market as a whole is due for a correction?
I think it's due for a nasty one. Look, for the last 18 months, J-Pow had your back. He's now effectively a headwind. Congress had your back. I think stimmies are frozen. Fund flows had your back. I don't think they have your back anymore because the dollar is strong. I just think that a lot of things are kind of start going against you in a bit. And look, I think oil rocket ships, and I think that probably shreds a lot of the other sectors. And, I think that we've had a clean shot where basically anything with a QSIP went up. And now I think you have to be more selective. And I think, Kevin, you really nailed this when you said it was a cycle, what's your phrase?
It's rolling bubbles? Rolling bubbles, that's correct, yeah.
I think this is rolling bubbles, and we're going to roll out of Ponzi and into energy and hard assets here. Whereas before, you could be long everything.
Yeah. Kuppy, so just circling back to that, so generally you haven't been long energy stocks, but making this call that the weighting of energy stocks inside the S&P is going to increase would entail energy stocks rising. You think that that's just going to be more that the relative value of the other stocks in the index are going to go down, or do you see upside on these energy stocks?
Well, I see upside of the energy stocks, of course, but I mean, I put on a call spread that pays off 15 times. I just think that's a better trade than buying some integrated producer and hoping for a 15 bagger. That's kind of crazy.
Right.
But then, I think a lot of the other sectors in the S&P, higher interest rates and a lot of inflation, which will crimp margins. I think these guys are in for a world of pain. And, the energy stocks will obviously go up. And I think a lot of the other stuff will go down, and maybe the overall market goes down as well, just because the energy sector is so small right now. But over time, just like tech went from being small to very big, I think tech will cycle out and energy will become the biggest component. It'll just, basically replace where it was in 08, I guess, the start of 08.
There you go. Now that's a call. It'll be the biggest component. And tech has got a long way to fall then, Kuppy.
I think the technical term is fucked.
Okay, so listen, we talked a little bit of energy, and we got to keep on energy because you wanted to chat about another form of it, and that's the old uranium. You aren't quite a yellow-eyed laser eye guy yet, but you are very bullish on it. It's one of your biggest holdings, and after a great run, it's kind of took a breather here, and I was wondering if you could update us and tell us what you're thinking on that sector.
Yeah, so look, I'm not a yellow eye laser guy, whatever. I got more important things to do than change my icon. But uranium is my biggest sector exposure right now. It's by far my biggest sector exposure. Look, the price of uranium went from $30 to $50. It went 70% in 2 weeks. That's a bit odd for a global commodity to do that. It's not natural, and it needed to pull back a little. This is healthy and normal. I think nothing's really changed in any way. This pullback is a great opportunity for people who don't have exposure to get some exposure. I think the thesis has just gotten better. The Japanese now, the new prime minister is very much gung-ho on uranium. So that's, a bunch of more power plants coming online.
I don't know if that was politically correct to say that, Kuppy.
What?
Gung-ho on uranium, the Japanese prime minister.
Oh, really?
Just kidding. Keep going.
Did I commit a hate crime?
I don't know. Maybe I'm wrong. Maybe I've been hanging out with my teenage daughters too long, and I'm politically oversensitive. Okay, and not only is it the Japanese, I believe that the Germans have also come back, and they're thinking of firing it up. It's funny how $20 LNG will do that to you.
Funny how that works, right? And the Brits are talking about it too. Look, there's a great Venn diagram on Twitter someone sent me, and it was the two circles and the intersection. And on the left, it was left-wing lunatics with unrealistic energy expectations, and then it was right-wing lunatics with unrealistic energy expectations, and then the middle is just uranium. And I think that exactly says what's happening right now. People have lost the narrative in terms of how to create energy and how to create green energy. Look, it's not always windy, as the UK just learned, and it's not always sunny, as I've learned, because I put solar panels on my roof here, and I swear it's been cloudy every day since I installed them. And so, look, I think people realize that they need base load, and coal is out. Nat gas has something of a future, but it's still carbon. And uranium is the go-to. It's by far the cheapest, and you don't run out of it. And I think you're going to see a lot more people realize that uranium is a viable solution. Look, the Greens have been kind of lunatics, and they're the ones who caused this crisis, but there's a certain amount of pragmatism because they want this thing to work on the green transition, and you're going to lose the mass support really fast if you're shivering at home in the winter. And so they need something, and it's going to be uranium. And I think you're going to get this bid under uranium where ESG can get behind it, and uranium will become an ESG commodity. I think you're going to have this bid as just all sorts of countries start supporting it. And I think uranium is going to do something absolutely batshit because Sprott's going to go corner the market. And,
right.
Even during this pullback, Sprott's been buying, yesterday they bought 100,000, whatever. But, that's 25 million pounds a year at that rate. That's a real number. And so I think this is all just going to work, and it's going to work in, true blow off sort of craziness. And it's my biggest sector exposure.
And so before the last time, you liked the Sprott Physical Trust, and that was your number one holding. Have you started to warm up to any of the companies?
Fuck no. No, that's not true. I own a ton of Kazatomprom. You might almost say that I've been responsible for some of the move because it's not that liquid. But no, I own a ton of that. You literally it's like buying the Saudis, between them and Cameco and the Uzbeks, you basically have the OPEC of uranium. And Kazatomprom is by far the lowest cost producer. They have the biggest reserves. They're the ones that can ramp up the fastest. I think they're going to play a little bit of a game with MacArthur River and keep it offline. But I think they're going to be the net winner of this because, everyone's model shows, demand going from, let's call it 180 right now to like 210 to 225 in 2030. And, that growth is mostly going to come from Kazatomprom. And you're going to see some mines come back online, but they're smallish. And I won't be surprised if 2035, as some of the power plants that are getting permitted right now, or even some of the German ones and Japanese ones that come back online, like what if we're 250 in terms of the demand side? Like where's that going to come from? It's going to come from Kazatomprom. So it's a growth stock that trades at a single-digit cash flow multiple and pays high single-digit dividend yield at today's cash flow, given the current payout ratio. It seems kind of mispriced. I mean, admittedly, it's Kazakhstan, but I've invested in crazier places.
You mentioned they were going to play some games with MacArthur River. What do you foresee or worry about on that side?
So I don't think it's going to restart like people expect it to. I know they've spent a fortune on care and maintenance, and they have a ton of people sitting around doing nothing productive at the mine site. But I think it's going to take a lot longer than people think to hire and train people. I think it's going to take a lot longer to get that thing online. I think there's actual mining issues that aren't really appreciated. You're 700 meters below ground, basically freezing panels underneath a lake. Like if it's fractured like people think it is underground, and I have reason to believe that it is, I think it's gonna be much harder to process the next couple of ore zones. I just think there's a lot of issues there. It'll restart because higher prices make stuff restart, but I think it's gonna go slower and be more dysfunctional than people expect. And I think it's more like a 3-year restart than 2-year, like they think. If I've learned anything about mining, and I've lost a fortune in mining in my career, it's that everything costs more and goes slower than you think. So I'm going to use that one to my advantage for once.
Well, that's great, actually. And I had this great fellow that reached out to me on Twitter, and he told me that they're renaming the Sprott, the Uranium Trust. They're going to name it the Physical Uranium Trust by Sprott, and it's going to be known as PUTS from now on. Big thanks to David at Animal Spirits for that one. Listen, Kuppy, why don't we talk a little bit about your KEDM? Tell people about that great product and what it does, and how it can highlight many of the trades that you're doing ahead of time before kind of it's out there in the open.
Yeah, absolutely. So go to KEDM.com. We have a 4-week free trial. We have a chat room where we're discussing a lot of these strategies, but we're tracking event-driven opportunities, mostly corporate events, but they're also fund flow events. We were talking about Valaris the day it came out of bankruptcy. Back when it was trading at 21, we flagged that. I don't give people, hey, go buy this or sell this. That's not what we do at all. So don't expect that. It's not a stock picking service. But what we do is flag the corporate event so that you can know the first day it's happening and, get there and start doing your work. We were very early on what was happening with uranium in terms of the fund flows and the ATM and the buying. We were there at $11. Here we are at 14.5. It's basically designed to flag what's happening. And I believe very strongly that one good trade will pay for a lifetime of this product. And so far, everyone seems pretty happy.
Well, that's terrific. So it's KEDM.com. You can check it out. And then, Kuppy, why don't you tell people where they can find your great blog? Because I highlighted it. It really was an outstanding piece that, as I said, I was jealous of. Why don't you tell people about your blog and where they can find you on Twitter?
Hey, thanks. Go to Adventures in Capitalism. The blog is free, which means you get what you pay for. But I tend to publish about once a week, or when something interesting happens. And hey, Kev, we haven't even talked about my other blog post. Look, I've worked some very large orders in my life. Sometimes you decide you want to buy 9.9 of something. There's no blocks available, and you just go into the market and buy it. And there's 2 ways to do this. Okay, you can work basically a VWAP order, and you're going to be 10% of the volume, and you're going to start just chasing the thing up. Usually, if you want to buy that much, it's because you really want to get it done because there's news coming, or you think there's news coming, and you want to front run all the other guys because you're probably a week ahead of figuring it out. Or sometimes what you do is you take a $10 stock and you just bid 13 out loud with your broker, or you go onto the machine and you bid for 500,000 shares, just show the whole damn thing and hope someone hits you.
Yeah.
And but that's how you get filled, because everyone's saying, it's trading
there's a dumb
10.
There's a dumb order.
10. I think it's worth 11. Yeah. Maybe you get some schmuck to short you a couple 100,000 shares. Yeah. They think they're going to buy it back at 11.5. Anyway, you usually get your trade done if you want to get it done.
Yeah.
And anyway, the Chinese just came out and publicly said, we're bid unlimited at 100 oil. They basically said that, or maybe they said 90. I don't really know, but they basically said, "Come hit us, we're the bid." And the market kind of shrugged because the market got clobbered yesterday. And I don't think the world realized that the rules just changed. It used to be you want some oil, you go secure a cargo from the Saudis. Now the rule is, it's not the price you pay, it's do you have oil? And I think that mentality will shift the balance dramatically in terms of the upside here. And I wrote a piece about that. And, anyway, Come join my blog.
Go check it out. Anyways, Kuppy, thank you very much for being with us, and looking forward to talking to you next month.
Happy anytime.
Okay. Okay, Patrick, it's time for Talking Charts. What do you have in plan for us?
Okay, let's get to the top 3 things we were watching last week. So the number 3 was the crude oil breakout, Kev. So when we pull up a chart here, it has been following through, right? And so crude oil continues to edge higher. There's a number of targets out towards $80 in the very short term. But what's interesting to me about the way that the pullbacks this week occurred is that each time we had a little pullback, the buy on dip traders quickly scooped it up and brought it right back to the highs. So in my mind, when I'm looking at these crude oil charts, it's continuing to show that it is being well defended. It looks like it's still going higher. Has your view changed at all on that?
Hi, what's more important is how you're the guy you cheat with me on. Has he changed?
I'm not going to say anything. All right, so
number 2, what do we got?
Is this a breakout in the 10-year yield? And well, I mean, it certainly paused for a few days here, but overall, there's been a pretty clear breakout, particularly on the 2s and 5s, in the big way to 52-week highs on that front. Is any insights on your mind in terms of how this is developing?
I don't know, but it's so funny that you mentioned 2s and 5s because yesterday I bought a bunch of both. That was what I bought. 2s and 5s. I feel like it was overdone. I feel that the market is getting way out ahead of the amount of, let's say, hiking that the Fed's going to do.
You're fading the bond breakout.
Yeah, no, listen.
You bought bonds.
I know, but listen. Patrick.
There's an imbalance in the force.
That's right. I am irresponsibly short the long end, though. So you have to remember that.
Okay,
and so when I saw yesterday with the market in trouble, the stock market in trouble, and I saw the 2s, they seemed to me that they were washed out. I started buying some 2s. I bought some 5s. I turned a lot of my just straight outright bond short into a steepener trade.
Yeah.
I know 2s at 25 basis points doesn't sound that sexy, but I really think, Patrick, that we might go through an entire cycle with the Fed actually never raising rates. Even though I am a bond bear, I think there's a decent chance that the tapering
once the market starts pricing in the tapering, the tantrum's going to occur. Like the Fed's not going to get to the interest rate part.
Well, we'll see. But anyways, for trade, I bought both 2s and 5s. That's all I can say about that. Yeah. Number 1. What do we have?
Well, it was just asking whether the market correction was over, and we both more or less suggested that there was vulnerability for it to continue. And once again, we broke down on the S&P down to at least overnight, we went to a lower low on it. The trend continues to be very weak. The one thing to me, though, is that while I do believe that this was a key turn point, and this could very well still turn into a 10+% market correction and roll, the one thing I just think that a lot of people have to be aware of is that there's no guarantee that this is going to be a straight line down. I think that that there's lots of room for there to be an upside fake out at some point that is just going to kind of get everyone to get squeezed out of their shorts and or rush to buy the dip, and it's going to be a fake out. So I just think that down here, it's like while I sort of share the view that that you and Kuppy have, I'm just a little bit nervous down here along there whether this is just going to just go straight down from here.
Well, I feel better because it feels like there's the force is getting more normalized. Because not only did I buy bonds, but you and I got it right that the stock market was headed lower last week. Very unusual for us to both to be bearish and for it to work. So I feel better now because I'm still bearish on the stock market. I still think that we're
I haven't bought the stock market.
I know, but the fact that you're looking for a bounce and worried about the rip higher makes me feel better.
Good.
Okay, what are we watching next week?
All right. Well, we're going to still stay with the oil theme a little bit because it's just we have the OPEC coming in on Monday, and it'll be really interesting to see whether or not the news that comes from there could either accelerate or stall out the oil move. Do you have any insights on what you think is coming from OPEC?
So OPEC's in a tough spot. We see a situation where, as Kuppy mentioned, China is giving instructions to members of their economy or of their society to go secure as much supplies as they can. And does OPEC want to, increase supply when they see this wall of buying coming at them? I don't know, Patrick. It's difficult, but the one thing I will say is that the volatility in this is going up, and we're going to see more and more violent moves as we get different types of news and more people become desperate to secure these supplies. And so strap in. That's what I would say about Tuesday's OPEC meeting.
All right. So number two, what I wanted to just touch on here was just the reversal of trend in the small caps versus the NASDAQ. Obviously, something we loosely highlighted, but I want to continue the conversation, was that there's been a predominant trend of the NASDAQ outperforming the small caps, at least for the last 6 months. But really, if the NASDAQ and these FANG stocks and the secular growth story continue to get pummeled, it would be interesting to see whether this trend shifts up. It certainly has, for the last week, turned higher. And it'll be interesting to see whether this is marking the beginning of a new trend where we're being along the small caps versus the NASDAQ works. You have any? Is that a trade you take?
I feel like those two actors in Step Brothers when they go back and forth and say, "Yep, I'm with you." Yep, is all I can say. I think that the small caps are headed a lot higher versus the NASDAQ. The real question to me that you need to ask is: can either of them can the small caps go up? With the Qs going down.
I'm a seller. I'm a seller on that. It's just about relative performance, right? So what's going to happen is that if the NASDAQ goes down 10%, then the small caps might only be down 5%. But then they'll be screaming higher or faster when the market turns up, right?
Yeah, that's the most likely scenario. Yeah, I would agree.
Anyway, so the number one thing we're watching is the jobs numbers.
It is an important job number next week. I know that on CNBC and the rest of the financial news networks, they say each month is the most important job number ever. But this one, you haven't heard this from me, but actually I think that this one could be one of the more important ones that we've seen in a long time. There's been some signs that the jobs haven't been growing as quickly as everyone expects. There's all sorts of indications that the economy might be slowing and having difficulties. If we get a really bad jobs number, it will be extremely interesting to see how the market handles it. Like, Patrick, I have a question for you. Let's say the jobs number shits the bed. Big, no growth. It looks terrible. Usually in the old days, you'd get a situation where that would mean that they would buy stocks because the knee-jerk reaction is the Fed's going to be easier for longer, there's going to be more liquidity, blah, 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 and you do it. I'm not so sure that that's going to be the case this time. I don't know. I'm not saying it's not. I'm just saying if you told me that you knew the job number was going to be bad, what was your trade? I don't know if my kind of instinctual previous feeling that you go buy the stock market would be correct. And in fact, I almost wonder if it's a sell.
The problem I continue to have is that I think that the damage from the coronavirus forced shutdown created that huge shock in the system, and then the massive reopening recovery, that it's sort of like the ripple waves after you drop a huge boulder into a pool. And while the ripples get smaller...
Whoa. Well, I got to stop you here. Why are you dropping a boulder into your pool?
I'm just using the ripple analogy of the water, buddy. And so, but the point being that I don't know whether a month-by-month number is actually even meaningful until we're still not long, we're still in actually some form of lockdowns and certain restrictions and all these different things. These numbers are incredibly volatile, and like watching monthly prints, it's like I don't know. It seems like you can't put too much onto these numbers.
Notwithstanding your Boulder analogy, that was actually a great comment. I completely agree that people get too hung up about one particular number, and the reality is that oftentimes when you look back 6 months later, you'll see that they were adjusted. Like, for example, wasn't there a very famous time with when the first George Bush was running against Clinton, and there was a terrible economic number, and everyone said that how bad things were. And Clinton campaigned on that whole thing about it. Are you better off today than you were 4 years ago, or whatever it was? And the reality was that the economy had actually already come out of recession and was on its way towards mending, but the numbers weren't showing it yet. And it wasn't until afterwards, like 6 months later, when they dug into the numbers with the getting out there and counting them up as opposed to estimating them, that you actually saw that had already occurred. So, Patrick, you're absolutely correct.
Yeah. Anyway, so let's talk some charts.
Okay, let's do
it. So what I want to do is let's highlight the dollar move. I know we're going to talk about this when we settle the bet, but that U.S. dollar really has taken off here, and I mean you've got some of these previous highs from October 2020, but this really has broken out of to the 2021 trade range. And the question I continue to watch is this just a quick little pop to 95, or are we talking about a potential sustained dollar trend where we're going back to the 100 handle?
Everyone's getting all bent out of shape, and although I agree that it is causing a lot of the pain, it's only because volatility in the dollar has gone so low and it's gone nowhere for so long that we've been kind of lulled into this feeling that this is a big move. Yeah. And one of the things that I've learned the hard way about currencies is that when they start trending, they seem to go longer than you ever imagine.
Yeah. What's interesting is that when you particularly look at the larger weighted component of that dollar index in the euro-US dollar cross, I mean, this is a very clear distribution cycle. I mean, it's really all year been selling. I mean, while it had that little second quarter pop, it didn't make higher highs, and it lasted just a couple months before the whole sell cycle began again. The euro's under a lot of pressure, and the chart looks awful, and it's hard to imagine that this is the period where we're imminently going to see a euro bull phase start. So under those circumstances, that could be a tailwind to the dollar in general.
Okay, what else you got for us next?
No comment, right?
I don't.
Anyway, so let's talk about uranium. That Sprott chart, because you and Kuppy were talking about it. We were talking about it with them.
You mean the Putz chart?
Yeah, the Putz chart.
Yeah.
And so the interesting part here is that we're now approaching that mark where it's given back about half of the gains that it made in that 1 month impulse higher. And typically, a 50% retracement of a move is a point of high interest technically, as a bull trend rarely kind of overshoots that level. It'll be really interesting to see whether this $14 area on the uranium fund actually marks a short-term buying opportunity. It's going to be something I'm watching at this level.
I think that's a great spot to look at it, and if you asked me to predict it, I guess we're going to chop around here for a while. And we probably won't go much lower, and we probably won't go much higher, and then we'll eventually get the strength ready for the next move. That'd be kind of my feeling from it.
Yeah, I want to just now touch on the ARC. Kathy Wood, Crazy Kathy here,
and that's not very nice to say.
And it's not. It's Kuppy made the name, but anyway, the way that ARC has been overall, it's just been selling all year. And
yes, it's been really people don't realize. Well, sorry, I shouldn't say people don't realize that. I think it's a lot of people might not be aware at how poorly it's performed this year. in terms of it's surprising, or at least for me.
Yeah.
I pulled it up and I was like, holy shit, she's actually down a lot of money this year.
Yep.
Like, what was the high in where did it finish at the end of the year?
At the end of the year, it was trading here like at like 100. Let's say I had a high of $138. Let's round to 140.
Yeah,
so she's down 30 points right now.
Yeah, but that's a lot.
Yep,
This is a portfolio. This is not an individual stock.
And more importantly, it's never really had any sustained buying, which is it means that anyone that's held this thing just sees a lot of red over and over again, and it fits into that whole rotation story we talked about. I mean, it's certainly these kind of unprofitable tech names that are all over her portfolio are going to take some of the blunt of selling, and more importantly, more her assets under management contract, she's going to have to do more selling. That is only going to exacerbate this situation, right?
I just realized something. I've been watching her on Twitter, and she's been saying stuff about that she doubled down on her oils headed to $12 call. And I realized that Kuppy is the anti-Kathy.
Yeah.
He's got the exact opposite trade on as Kathy. So there we go. Kuppy is the anti-Kathy. So what do you see when you look at the tea leaves here? Where do you think that's headed? Where would you get more excited about on the short side?
Well, I mean, look, right off the bat, it deteriorating back down to that retest that $100 low. It seems at this stage the path of least resistance. The bigger question is this a sustained bear market? Because if this turns into the charts of blow off tops that end up, like think of after what silver did after its 2011 peak, right? It just had a couple rally attempts, but just month after month after month kept bleeding in what was more like a prolonged Eiffel Tower formation, right? And this, if it gets down to 100 and then has failed rallies, then this just could keep bleeding.
So I would say the only difference there, Patrick, is that silver bulls are used to that sort of pain and the ARC bulls aren't used to it.
Sure.
Okay, what do you got next for us?
I would just wanted to highlight quickly that Tesla, which is a holding of Kathy,
but she's selling it. She's been selling it. That's probably because it's going up. She's selling it because she's keeping the losers.
But it's been moving higher, and it's interesting that Tesla keeps bucking the selling. I mean, you have the FANG stocks being hammered, you have the ARC stocks being hammered, and Tesla, like Elon Musk, is borrowed some of that Teflon from Trump. And
there we go. Just to make sure that piss everyone off, you're going to compare Elon and Trump. So to get
it's just some of his Teflon, not.
So I will agree with you, Patrick. I've been looking at Tesla and I've been just perplexed at how it's bucking this trend. And I thought to myself, if I looked at that chart and I didn't know the symbol, and I didn't have my terrible bias
You'd
against
be bullish
it,
on it.
Like it would be tough to be bearish. Let's put it that way.
Yeah. No. There is not negative price action. It makes higher highs, higher lows. Each dip is being contained. We haven't seen the sellers in any way regain control of the downside here.
The only pushback I will say to that though is Viacom looked really good technically until Archigos or whatever they was.
Look, but there were technical signals on the first break. Maybe you wouldn't be selling the high, but you would see the trend break. There's no break of the trend.
You're absolutely correct, Patrick. Why bother fighting this? And I've actually given up. Well, that's not true. There's always a little part of me that is shorted, and I still always have it. But I have given up using that as my main vehicle to bet against the market because I just said, well, why pursue a life of pain? I can go figure something else out that's a much easier short. Speaking of easier shorts, gold. What's going on here?
Well, you know what? I mean, what's interesting is that generally here, gold has bounced at least in the last few days. This is just a GLD off of its low. But gold and silver obviously have been leading the way down. They've been sniffing out this tightening and the current cycle a lot quicker. At least you've been highlighting that. And yet we now saw this little 2-day reversal in gold and silver off of their lows, and it makes me just obviously pay attention. Just makes me want to see whether or not the bulls can this time around make it stick, because so far they've failed every single time. And so it'll be interesting to see how much follow through there is on this uptick. And I think it'll be a big tell as to whether the trend is shifting or whether there's more pain to come.
I feel like I'm no longer allowed to talk about gold because I've been so wrong. I'm in the penalty box. 2 minutes for looking so bad. Only people get that joke.
One final thing I want to highlight here using this amazing Koifin platform here is I wanted to look at the U.S. sectors here, and what I wanted to just highlight is that look at all the red, except there's one little green right at the bottom of this U.S. sector. Energy up 6%, but look at the way healthcare, technology, real estate, everything is being hammered. But the financials are relatively flat. They've been taking quite a bit of that rotation, and they've been somewhat of a defensive thing in that kind of the cyclicals working there. But definitely it's the energy bucking the trend. The other interesting thing is like the biotechs down 9%, just hammered. On the downside, and it's interesting, like that the biotech space is the focal point here. You would think that with still the coronavirus and all these other things that this wouldn't be where the focus of the selling would be, and yet here we are, like down 9% on the week. This has just been an ugly week in the biotechs.
I loved your little plug there, Patrick. You're like Jim Grant. I know he loves his Casper mattress, and we love our Koifin product.
Anyway, so definitely lots of really interesting things to watch, and I mean we'll continue this conversation next week, right?
Okay, it's time for This Week in Trading History. What do you have for us?
All right. Well, you know, it's funny that Kuppy brought this up during Kuppy's corner, and I sort of had this prepared beforehand, but it makes it a fun thing to talk about. It was September 30th in 1981 that the 10-year Treasury yield hit its all-time high of 15.84%. Right? That's a big number, eh, Kev?
It is. So what was that, 1981? I was 11. I was 10. I wasn't yet 11. I wonder my parents what they felt about their mortgage at that point.
Oh, that was 20+% mortgage rates back then. Yeah, that was crazy.
Can you imagine? Because we just take almost the mortgage rates for granted.
Oh,
right?
yeah.
Like, can you imagine having 20%? Think about that. You take down like let's just take we're here in Toronto, so all the house prices are stupid. So let's just use $1 million house. So $1 million house, you have a $200,000 of carry.
Kev, you know what's funny is that we talk about how expensive Toronto houses are until I've been around Europe, and I realize it's not much different anywhere.
Like, so I have a good buddy that has been arguing this. He's in real estate. He's been arguing this with me for a while because I've been bearish for way too long. And he always said to me, he said, Toronto is on its way to becoming a world-class city. Now, before anyone says this hate mail, we know we're not a world-class city, but we were before just like...
No, forget world-class city, dude. I'm talking about every city.
But what I'm saying is that Toronto is on its way to at least being a competitor for
I just think
large
that it's a function of interest rates and mortgage rates, and now
I think it's also immigration.
Are low everywhere.
I think it's immigration in Toronto.
Anyways,
we shouldn't talk about it.
Let's talk about
this for another day.
Exactly. All right. So let's talk about what happened. So Paul Volcker was appointed chairman of the Fed about a year earlier, August 1979, in large part because of his anti-inflation views. He felt strongly that mounting inflation should be the primary concern for the Fed. In terms of economic stability in the future, inflation is what is likely to give America the most problems and create the biggest recession. At least that's what he was quoted as saying. He also believed that the Fed faced a credibility problem when it came to keeping inflation in check. During the previous decade, the Fed had demonstrated that it did not place much emphasis on maintaining low inflation, and public expectation of such continued behavior would make it increasingly difficult for the Fed to bring inflation down. Failure to carry through now in the fight on inflation would only make the subsequent effort more difficult. So Volcker's first attempt to lower inflation and inflationary expectation proved insufficient. The credit control program initiated in March 1980 by the Carter administration precipitated a sharp recession. As unemployment mounted, the Fed eased up an action reminiscent of the stop-go policies the public had come to expect. But it was in late 1980 and early 1981 that the Fed once again tightened the monetary supply, allowing the Fed funds rate to approach 20%. That's the Fed. I can imagine that Fed funds rate up to, it's unbelievable. So despite this, long-run interest rates continue to rise. The 10-year Treasury bond rate increased from 11% in October of 1980 to that 15.84% in This Week in Trading History back in 1981, possibly because the market believed the Fed would back down from its tight policy when unemployment rose. This time, however, Volcker was adamant that the Fed not back down. He was quoted saying, "We have set our course to restrain growth in money and credit, and we mean to stick with it." The economy officially entered a recession in the third quarter of 1981 as high interest rates put pressure on sectors of the economy reliant on borrowing like manufacturing and construction. Unemployment rose from 7.4% at the start of the recession to nearly 10% a year later. As the recession worsened, Volcker faced repeated calls from Congress to loosen monetary policy, but he maintained that failing to bring down long-run inflation expectations now would result in more serious economic circumstances over a much longer period of time. Ultimately, this persistence paid off, and that by October 1982, a year later, inflation had fallen to 5%, and the long-run interest rates began to decline. The Fed allowed the Fed funds rate to fall back to 9%, and unemployment declined quickly from its peak of around 11% back to 8% a year later. And then that's when the 1980s period really started. So that was the peak, Kev.
That's a great story. You did miss talking about the fact that Volcker, not only was he presiding over the peak of interest rates, he was the peak of the height, and that every subsequent Fed chair has been shorter ever since then.
That's a very important observation.
Oh, until Powell.
Yeah,
so
Powell
actually,
was
you know what?
yeah.
Now that I think about it,
Yellen was the trend changer.
That's Yellen was the bottom, and we're headed higher. That's another reason you should be bearish bonds.
Okay. All right.
Okay, Patrick, it's time for skin in the game. And I won one, right?
Yeah. And humiliatingly, I've been bullish the dollar, and I just was not willing to stick by my guns, and because I thought you were cherry picking me with the higher one touch, and well, you got me, buddy.
I did. It was funny to see you lose that one because you are usually such a dollar bull, and it ended up being not even close. Like you lost it in kind of like a humiliating fashion, where it was the first day, second day maybe.
It was awful.
Anyways, let me tell everyone about this game. Our Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other one chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows: a Duke and Duke, a pint of beer, a burger bet, a pitcher, case of beer, which is a 2-4 bottle of wine, or the granddaddy of them all, the steak dinner, which I have lost a few of. The winner of the bet is obligated to create a new bet for the following week, so that falls to me. All wagers settle in full, and there will be no netting of positions. Okay, so Patrick, we're going to do one that's slightly different this time.
Okay.
And I did not give you the heads up. We're going to bet on the non-farm payrolls.
Oh.
Now, I was kind enough to send you a chart of the Bloomberg economist estimates.
Okay.
Okay, so go to your email.
Okay.
And you'll see that the
You sent me 2 emails. Which one?
Well, I'm not sure. I think I sent it twice by accident, or you're just seeing double, maybe.
I'm seeing double.
And so the median estimate is 470, and the distribution is there in front of you, and you'll see it. And I'm going to give you high or low, but it's not going to be the median estimate because I have a bias. I'm going to give you 410, high or low. So you up or down?
I'm going below 410.
Oh, that's what I wanted. Okay, well there it is.
All right.
Well, you know what? You're probably going to lose again.
Yeah, it's probably going to be the case. But you know what? Like, I think it's a cop-out if every week we're just adding pitchers, because it seems like it doesn't show our listeners that there's any conviction in our calls. So
okay.
I think
I'm going to go at burger at most.
Oh, because you think because
I wanted that too. I wanted the lower as well. So
you know what? I've been out of the North American side. I haven't actually had a burger for like 6 weeks.
Oh my God! Well, there you go. So listen, I'll tell you what. Let's do a burger. One of us buys when you get back.
Done.
Okay, sounds good.
All right. So it's going to be over under 410.
Right.
And I take the under.
That is correct.
Done. All right.
Okay. Now, what is it? No listeners, no stupid questions. That was what they called. I can't even remember.
No,
I feel like I'm the one drinking. I know we don't have any, but we are going to get on here, and Lena's going to hop on, and she's going to make an impassioned plea for people to send questions because we actually have run out of questions. Wow. And I know some people sent some old ones, and we almost chose some old ones, but unfortunately, a lot of them, the market's moved or whatever because we got like so many all at once. And then we could only do a 3 a week, and therefore now they just seem old and stale. So we need new ones.
Yes.
Right.
And some of the questions are very, very long. If you keep it much shorter, it would be much easier for us to answer.
As in, like one question.
No, not just one question. We've had some emails where it's like few pages long.
Yeah,
which is
but literally just one question would be perfect.
Yeah, no. We listen. There's lots of
context.
We choose the ones
with
that
a
have
question.
That are fun. Like there's
no. Listen,
you want to get on there, making a few jokes definitely puts you to the top of the list.
Jokes are fine, but it has to end with one question.
Okay, fair enough. Yes,
but we do appreciate all questions.
All questions, but one is better.
So, Lena, why don't you make the impassioned please, because they're not going to do it for us, but they might do it for you.
Please send us questions for Kevin and Patrick for No Stupid Questions segment at nostupidquestions@markethuddle.com. I'd really appreciate it.
Oh, love it. Love it.
Okay.
That's the show, bud.
That's the show. Okay, I was just trying to find my script, and I was stumbling, and I was hoping you would...
You're not even drunk yet.
Which you did.
I'm drunk.
Okay, so thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle. We're there on Twitter every day. Lena gets tired of talking to Patrick and myself, and she doesn't even do that these days. Do you, Lena?
No comment.
You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And a little aside here. Today we had a great deck from Darius, and it's very difficult after the fact to send it out to people. If you want to make sure that when you have access to that material, get on our Market Huddle email list, and in doing so, you will always have a link, and it'll be much easier for you to grab it. And we promise not to spam you. We're not doing anything with that. You're literally just going to get one email a week when we put up the show with the links. It's really easy peasy. And please, if you could, rate and review us on iTunes. You know why. Patrick, think you can get out of where they can find you?
Yeah, I think I'm going to be all right. They can find me on Twitter at Patrick Ceresna, and you can follow me at bigpicturetrading.com. Kevin, where can they find you?
I'm on Twitter at Kevin Muir, or you can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
I slurred my way through that.
Yeah, it was pretty good, actually. I kind of enjoy drunk Patrick showing up. So what do you think of the beer?
It's a pretty down the center lager. Like it's no, you know what? Honestly though, it's a great tasting beer, but like it to me,
so many beers in, don't all beers kind of taste the same after
That's
a
right.
while?
yeah. And this doesn't stand out in any way. Like, yeah, I could easily drink 6 of these, and
You can
Which I did.
easily drink
Which I
any
did.
6
Which I
beer.
Give us your score and just end this like a bomb. Just get this over with. Like, let's just get
I'm
this.
gonna give it the 7.5.
7.5,
Okay.
right down the middle.
It's right down the middle. It's a great beer. I would never complain about it, but it's not a spectacular beer.
Okay, so now we got to ask you questions. Lena and I are living a boring lives here in Toronto. You're the one
Yeah.
that's the international man of mystery. Where are you this week?
Well, I'm in Vienna, but I was last week when we were recording, I was out in Prague. But you know what? Unfortunately, I'm gonna be on Canadian soil tomorrow.
Well,
I'm going to go for the moose hunt, buddy.
yeah, I know. We'll talk about the moose hunt in a second. I have one question. When you ask people which song of Vienna they like best, do they just all roll their eyes at you, or does anyone actually answer you? There's 2 very famous Vienna songs. One is a Billy
I've
Joel
never
song.
asked.
Oh, you don't
I've
even
ne-
know.
I
You don't
have-
know. There's a Billy Joel song, and then there's an Ultravox song. So this is your job, is to find out which one offends them the least. Because I'm sure they're fed up by hearing about it.
All right, I'm going to find out.
Okay.
No, he's not. He's going to forget
No,
about
I'm going
it
to find out. Like, I'm literally going to find out.
Okay. That's it, a good plan. And then you have to give me your decision about which one you like better.
Which I have to mean.
I can't believe you don't know the Billy Joel song.
No.
Really?
Are you
No, at
surprised?
least it's not.
Pop culture
It's not
references?
easy.
I
Yeah,
don't
it's
know.
not easily
like the
referenceable to me.
Ultravox song, I kind of understand. He might not know that. Like he was a heavy metaler. Like he was like Bon Jovi or Dead or Alive or Twisted Sister. He liked that kind of stuff, right?
Yeah.
Okay, so let's talk a little bit about the moose hunt, because are we gonna have another show before the moose hunt, or are you moose hunting before?
Oh,
the next-
literally, I'm landing on the plane. Well, on the plane, in the plane, lands in Toronto.
Yeah.
And I'm gonna pretty much pack my bags and head up north. I'm gonna be this weekend already.
So you're
up at the camp.
you're isolating with your buddies moose hunting.
Yeah.
With crossbows.
Well, hey.
Okay, so
stuck out
I
in
have a
the
question for you. Have you ever shot a crossbow?
Yeah, of course, I have one.
Oh, you do. Okay, it's not like this. Not like this is your first time.
Yeah, this is. Oh, yes.
He used to use them for squirrel hunting.
Yes, I've
Have
killed
you ever
many
hunted with a
squirrels
crossbow before?
Yes.
What did you hunt for?
Deer.
Oh, really?
Deer. This is the first time I'm actually crossbow hunting moose with a.
It must be a monster crossbow to go for a moose.
No, it's just the tip at the end. It's the same crossbow.
Really?
And what do you guys
Yeah.
do with the moose after?
You eat it.
Yeah, you eat it. Gotta eat
Oh,
it.
of course.
Yeah.
There's no point of hunting for one if you're not going to eat it.
Yeah, that's just
Yeah, that's just
weirdo.
mean.
No, it's actually really delicious.
So I know a lot of people crossbow hunt turkeys. Have you ever done that?
Yeah.
So
I've never got one, but
Really?
but I've done it. But I've
because
never.
they seem stupid as heck. They like pheasants. Like I don't understand how anyone can pheasant hunting has got to be like those birds are the dumbest things in the world. They get in front of your car and
the grouse. Yeah, no, absolutely. Like literally, you could walk up with a shotgun like 6 feet away from one and just it's almost unfair. It's it's almost unfair, but turkeys are actually super smart. They're really hard to lure in. You have to
you're not allowed to shoot them in the trees, right? Like at night when they go up and they route and they roost in the trees.
You have to hit them on the field and bringing them in. They're pretty smart. Like
you have to call them, right? Like you do you pretend like you're a female and you bring them in.
Exactly, and you have to bring them in, and you have to get them hot and horny, and call them in.
So, do you all do that, or is there one guy amongst the hunters that's like?
I haven't turkey hunted for like 4 years. You're like asking complicated questions, but
you've never got one.
No, I've been in groups where we've gotten turkey, but I've never been the one at the trigger.
Right. I've actually eaten one.
I've only killed squirrel, buddy.
That's all you've killed? Like that's the hunting?
I'm the worst hunter in the world. Like it's. I'm there for the booze.
Are you being serious? That's all you've killed? It is.
Oh my god.
You know what?
I thought he was kidding.
I kind of love that about you, Patrick. I think we're just gonna leave it there. That is a lovely way to end it. Patrick, the moose hunter that doesn't have a hope in hell of ever hitting one. You're my buddy. Okay, buddy. Listen, you have a safe flight home. Have a great week drinking booze with your friends and looking at things. And we'll see you next week.
All right. Well. Thank you for the kind words. I mean, it's very encouraging.
Okay. See you later. Have a good weekend. Right. Take care, guys.
Take care, everyone.
Bye, Liam.
All right. Cheers. Bye.